New data on wholesale inflation showed prices rising more than expected last month. A separate report on retail sales rose less than forecast. Together, they make the path to potential rate cuts more complicated for the Fed. And here to help us break down the data and its implications, we're bringing in Interactive Broker senior economist José Torres. José, it's good to see you. So I know there's always the caution against just looking at a handful of data points and trying to extrapolate what the Fed is going to do. And certainly the Fed is looking at the 6 months trends in data. So how should we read what we've been getting for January and February?
Thanks for having me, Julie. Well, January and February, what we've been getting is goods and commodities reversing their progress from last year. Goods and commodities deflation paved much of the disinflationary trend last year, but now they're starting to reverse higher. You have oil at around $81. Copper made one-year highs yesterday, so did lumber. We're seeing commodity prices increase. We're seeing goods transportation costs increase, and services never really cooperated. That remains hot as well. So what we're seeing is in the beginning of the year, investors expected 7 rate cuts. Now they're expecting 3. And as these hot data continue to come in, they're incrementally delaying the Fed's first rate cut and extending our journey across the risky monetary policy bridge.
Do you think, Jose, I mean, it is interesting to hear, some smart strategists out there who are saying maybe no cuts, Jose. I'm thinking of Dr. Ed Yardeni, who's saying, he still expects 2 cuts, but he did see an increasing chance, he's telling clients, of no cuts, just given what he's seeing with these kind of financial conditions easing the way they are.
Absolutely. The economy is doing just fine. The Fed has a dual mandate of maximum employment and stable prices. And the employment side of the mandate is not under threat at all. Right now, it's inflation that's, sticking there at right around 3%. CPI bottomed last June at 3%. We haven't seen a reading below that since. The economy is doing fine. Financial stability concerns have been placed at bay. The employment market is doing great. We have strong job openings. We have wage gains. We have good job growth. So there's really, unless inflation starts to reduce more significantly or the job market begins to weaken, there's really no reason for the Fed to cut here.
And what is your take on the effect on consumer spending? Because obviously we've seen consumer spending hold up pretty well, retail sales today being a little lackluster notwithstanding. But we also have heard just a drumbeat of negative sentiment related to inflation, even if it's moderating, still obviously prices being considerably higher than they were a couple of years ago. Does that start to pinch consumer spending at some point?
Julie, I don't think so, because what the consumer is doing is the propensity to save has been reduced. There is not as much of an incentive to save for big ticket items because of rates being elevated. Also, there's not an incentive to save for down payments because home prices are really elevated alongside rates. So what consumers are doing, instead of saving, they're spending almost all of their money, and that's really fueling consumer spending, particularly in the services segments. As far as sentiment being negative, there is an offsetting factor there, and the fact is consumers have plentiful job opportunities out there. They can go out, they can bargain for better wages, they can ask for increases. In the ADP survey, we see that the gap between job stayers and job changers is still very wide. So those dynamics tell me that the consumer, albeit they are pressured by reduced credit availability, higher prices, and higher rates, they're still doing all right. And also rents are, softening. Not as fast as I think the consensus thinks, but rents are softening, so that's good news as well for the consumer.
So, Jose, given that view on the consumer, then are you in the soft landing camp? So inflation, you think, returns to 2% without a downturn?
Josh, sometimes I wonder if the Fed is going to accept inflation at around 2.7, 2.8%, right? And before we saw inflation up in the 8s and the 9s, so 2.8 may not seem like much, but remember, it's still 40% above target. And I think that's really the difference, Josh, between whether we get a soft landing or a hard landing. If the Fed really tries to go to the end with inflation, it doesn't look like they are. So right now, I'm in the soft landing camp.
Jose, good to see you. Thanks so much.
Thank you.